Hi everybody, my name is Aarth Shahstri and today I'm going to be talking about bonds. Now, if you've watched my stock market video, you already know that when you buy a share or a stock, you purchase a piece of a company, but it's completely different with bonds. So, what are bonds? Bonds are basically a loan, but instead of borrowing money from the bank, you're the one who's giving the loan. So, you are the bank. So, let me give you an example. If I lend my friend $100 and he tells me I'll pay you back in 1 year, I'll also give you $5 as a thank you. So those extra $5 which I got, that's called the interest. Now, this is exactly how bonds work, just on a bigger scale with larger numbers and more quantities. When you're buying a bond, you're lending your money to either a company or the government, and in return, they promise to pay you interest regularly, and eventually they'll return your full amount with the interest. And yeah, so why do companies and governments issue bonds? Why do they need your money? Companies need your money to grow their business, to launch a new product if they have to do research for it, uh, or if they want to build a new factory in order to increase their output. Governments might need money to build roads or build schools, hospitals, purchase new weapons for defense or military. But instead of asking money from the bank, they issue bonds. They sell bonds to people like you and me, and we buy them. So that's like basically saying that sure, I'll give you the money now, just pay me some interest and give me my full amount after some time. And that's how bonds work. Now, how do I make money from this? uh, we make money from this in two ways. One way is the interest payment, which is also called the coupon. uh, this is the $5, for example, the interest which I got, which my friend promised me. It's basically a regular payment. It's like a reward for lending your money in simple terms. And second way is selling the bond for a profit. Sometimes you can sell a bond for more than you paid, because but sorry but usually people buy bonds for the saves, for the steady interest, the normal interest it gives. No big price changes like stocks. Stocks have a lot of volatility, which means their price fluctuates from, let's say, 100 to 50. So if I buy it at 100 and it falls at 50, I'm making a loss. But this doesn't happen with bonds. Bonds are usually steadily priced, they give you a steady rate of interest, and they are much safer because there's no volatility. So now that I've told you about bonds, let me just tell you a few basic terms that you must know. Let's start with the first one, which is called the face value or the principal amount. This is the amount of money that you lend, like the $100 which I lended to my friend. Then coupon rate, this is the interest rate, so it's the rate of interest that you earn. So in my example, where I got $5, that was the coupon rate. So the coupon rate was 5%. So the coupon rate, interest rate is the same thing. It's 5% in my case. And maturity date. Now, person has to give the money completely by some point of time. You can't have a loan and just go on forever. You have to pay the money back. And maturity date is basically the date where you say that okay, at this by this date I'm going to be paying my full amount uh, to you or to whoever. And the last term, issuer. This is the company or the government that you're lending your money to. Those are the people getting the money, right? So, super simple, no complex, nothing. Now, you'll tell me, okay, I know how to make money, now I know what bonds are, but are they safe? Because at the end of the day, if I invest 100 rupees, $100 into the market and I am not even getting 100 back at the end of the day, that doesn't mean that my investment's safe. It's gone down. Obviously, that during a short period of time there will be ups and downs, but how safe is it? For example, crypto could be considered as quite risky investment. So can be stocks because they're extremely volatile. They change a lot depending on the demand and supply and the price. So are bonds safe? Yes, they're safe, and they are usually much safer than stocks because they give you regular payments in the form of interest, and you're more likely to get your money back because the people who you lend your money to are usually the entities which can really manage their finances well and afford to pay that money back. But not all bonds are the same. There are, let's talk about the two different bonds over here. For basics, the government bonds, they are usually very safe, like the US Treasury bonds or the Indian government bonds. Then we have corporate bonds. Now, these can be riskier because if the company that issues these bonds fails, goes bankrupt, uh, although as a stockholder you will lose your money that you invested in the company, but if you're a bondholder you're going to get that money back because you're the person on the top priority uh, who will get the money back because they have to. It's an agreement between the issuer and the person who is giving the money. This is why bonds are considered less risky than stocks, because uh, a company or the government is obliged to pay the bondholders their money first. So bonds are safe. Now, why would I buy a bond? Uh, Bonds are usually part of old, not always, but usually for steady investments where they give you a regular income in the form of an interest. Uh, they are less compared to they have less risk compared to stock, and people want to diversify their investments, so not all of their money is in equity. Some part of it is in bonds, some part is in real estate, because if you put all of your money into stocks and the stock market crashes, you've lost all your money. So it is best to spread your eggs and not put all of them in the same basket to avoid them from getting crushed, for example in this case the stock market. So bonds give you like a safety net in this case. Now, like how we discussed, there are different types of bonds. Not all the bonds are the same. There are three main uh, types of bonds with each of its own purpose. All of the bonds, all of the stocks, they have one purpose. Not one purpose. They have different purposes. They have been issued for different purposes. So, firstly, we have the government bonds. Now, these are issued by national governments like US or India. They're considered the safest bonds because the government rarely defaults. So, defaults basically means when you're not able to pay the loan back. It's just a fancy term, but that's what default really means. And when you invest in government bonds, you're basically lending your money to the country, and in turn, you will be paid with interest regularly. And because it is uh, very safe, it is more likely to give you low rate of interest. And governments issue bonds to fund infrastructure, to build infrastructure like airports, uh, government buildings, bridges, and defense, military, public services, hospitals, etc. Next, we have municipal bonds. These are issued by the local authoritative bodies. For example, let's say a city wants to build a new bridge to connect from point A to point B, uh, but they don't have enough money, they don't have enough capital. Capital is the amount of money that you need in order to finance this investment. So they are going to be issuing municipal bonds to raise funds from investors like you and I. These bonds can be slightly risky because it's not the it's not the government which is uh, going to be paying the interest. Although it is the national government, it is considered safe, but this is where we have the government bonds, this is the municipal bonds, and finally we have the corporate bonds. Now, corporate bonds are issued by companies that need to borrow money in order to grow, expand, manage their operations. Uh, let's take of let's take a big company, for example, Apple or Reliance or Tata. Instead of taking a bank loan, they can just issue uh, corporate bonds. This will help them to raise capital from their investors, and as an investor, corporate bonds tend to offer higher rate of interest because uh, companies can be very successful sometimes, and they can be making losses sometimes. So in the long run, they usually break even. Break even means where they just balance out. So it's a more risky investment. So we have the government bonds, then we have the municipal bonds, and then we have the corporate bonds. And because they offer high returns or the high interest rates, they also come with high risks. Like, more the risk, more the reward. So it's always good to check the company's credit rating before investing in it. Now, what's credit rating? Credit rating is basically a rating given to a bond. Uh, so bonds also have classes. They are rated like school grades A, B, C, D. For example, we have AAA bonds, AAA bonds. These are usually considered extremely safe, and they are very rarely to default. Then we have BBB bonds, triple B bonds, BBB. They are also quite safe. Then we have CCC, which again reduce in safety. Then DDD, then etc. So uh, we have a last type of bond called the junk bond, which is risky but it can pay you high interest. Like, again, because it's risky, it gives you high amount of interest. Now, who gives you these ratings? Can anybody say that, oh no, this company is good, it has a high rating? No, the ratings are given by financial bodies. For example, in the US, we have Moody's, S&P, and Fitch, which give the ratings for the bonds. Now, as a person who has to invest into bonds, now if I want my investment to be safe, I will go for higher rated bonds because uh, they are rated high because they are usually guaranteed to give me my money back. But of course, they can default. But if you are uh, willing to take risk, you have a risk appetite. Usually people who are young, they invest in low rated bonds because they have a chance to get higher returns. And plus, uh, we have, as young people, we have time. If we make a loss, we can put our money elsewhere and we can get more money from that investment to make up for the amount which we had here. Now, how am I supposed to buy bonds? Where can I buy bonds? Okay, I like bonds. Uh, we can buy bonds on stock exchanges, through banks, and sometimes you can buy them online. For example, in India, we have RBI has a website or a platform called Retail Direct, where we can directly buy government bonds from RBI directly. So there is less amount of chance that you lose your money through online fraud or scams or wrong links. Uh, Now, just to summarize, uh, stocks have they give you ownership in a company. They have a high risk, high reward. Bonds, it's lending. It's lending. Always remember that. They give you lower risk and they give you steady reward. So you get your interest maybe annually, meaning every year. If your investment is for, let's say, 5 years, every year you get some amount. And if it's for 1 year, if it's a shorter duration, you get it every quarter, which is every 3 months, or you get it semi-annually, which is after every 6 months, and etc. Now, bonds are a way to grow your money safely, and they also give you regular income, which can be very important for people with low risk appetite. And that's it for today's video. Thank you for watching. See you next time.